like to be very practical at ScotSoft and give you information you can really use. So the next two sessions are all about that. We've assembled fantastic teams. The first one is to talk about starting up, how you get your funding. We've got some incredible talent in terms of venture capitalists, both from here and also from Silicon Valley. What kind of way should you pitch a company? What are they looking for? How should you do it? What kind of deals are possible? What kind of negotiations and so forth? So let's cover that. And then we'll have a switch of team, and we'll have our second team on to talk about growth and managing growth. We've got some guys here who have taken their companies from nothing to massive amounts of staff and business and value, and all the challenges of how to manage and build those growths. So we've got some pretty interesting challenges, some interesting sessions coming up. And we'll break for coffee at 3:15. So we've got an hour and 3/4 to cover these two topics. So if I could invite the first team up, and I'll introduce them while they're getting themselves settled in. We've got Eddie Anderson, Anne Winblad, and Heidi Roizen. Anne Winblad is the co-founder and managing director of Winblad Venture Partners, leading venture capital firm focused on software investing. They manage over $1 billion in cumulative capital, and they've launched over 100 new software companies. So she's very much in the heart of this whole business I think many of you probably have heard of Winblad over the years, being the company behind so many incredible startups and growth businesses. Heidi Roizen. Heidi will be known to many of you because for some bizarre reason about 3 years ago she decided to transport her family over here and had a wee sabbatical in Scotland for the autumn of, what, was it 2010? Yeah, and it was great to have her here. But Heidi is a real Silicon Valley lifer. She started a company called Teamaker and built that company up to its acquisition. She then became VP Developer Relations at Apple. She then joined Mobius Venture Capital as venture capitalist. She's currently a venture partner with one of the top companies in the business, Draper Fisher Jorgensen. She's also a director of a number of businesses. She's director of TiVo, which was actually co-founded by Edinburgh's Mike Ramsey. And she's also a director of DMGT, which most of us will know here as the Daily Mail. They're... Heidi is very much in the whole swim of these sort of things. And she currently teaches a class called Spirit of Entrepreneurship at the engineering department at Stanford University. Interesting, that's the engineering department, not the business school. Interesting. And then we've got Eddie Anderson here. Eddie Anderson is the founder and managing partner of Pentech Ventures. Eddie built a business called Objective Software Technologies, a software tools company, and that was sold to Wind River Systems, and he did a bit of integration in that and built a big section of Wind River. When he left Wind River, he decided to start Scotland's really specialist IT and communication fund in, 2002? Yeah. And that company, that fund has now invested in about 25 companies, many of which have been very successful. So Eddie is our local ICT and communications venture capitalist. So actually, Eddie, you've got a few slides, so why don't you kick off? What I'll do is I'll ask all three speakers to give a few comments, and then I'll ask maybe a couple of questions or throw it open to you. So if you want to think about your questions, then please do. Okay.
Thanks, Ian. Yeah, thank you. Listen, I've just got a few slides, really just talking about the options that are available for funding, and more particularly, how best to engage with venture capitalists if that's the route that you do decide to go down. So as Ian said, our fund is Pentech. We are focused on UK software companies, and I guess our sweet spot is investing in the A round. So I guess the investment round just after the companies have started to make a little bit of progress, but before they're really ready to scale. But of course, because we're such a focused investor, we opportunistically invest at seed and at growth stage as well. And we invest in software in its broadest sense. So that's internet, e-commerce infrastructure, SaaS, big data, a whole range of businesses. So I guess at its at its simplest, there are two basic types of finance, equity and non-equity. And there are pros and cons for each of these. And to some extent, it really depends on the stage your business is at, for one, and also just how ambitious the founders are in terms of really trying to accelerate growth in the business. So non-equity bootstrapping is a great and ever growing in popularity, I would say. You know, where you're very close to customers, you almost use customer cash to fund the development of the business or the product. And that's good because it keeps you lean and hungry and actually responding to what customers need. But of course, one of the cons is that if you do start to see progress, you can often be cash constrained and so not really able to take advantage of a market opportunity. Venture debt or debt and bank funding, probably in quite short supply, especially for folks in this room, based on the types of businesses that you have. But again, it's really dependent on the stage the business is at. If the business is slightly later stage and predictable in terms of revenue, then you can raise venture debt finance. There are many venture debt providers that are available that are operating in Europe, and so that's definitely a source of capital. But it often doesn't fit earlier stage, high growth technology companies. Angels are, they provide a function here and have done a lot of good work. I think they're clearly fast in their decision making. The terms may be more advantageous, but I think there's a debate about that. I think one of the main cons in terms of raising finance from angels is that they typically don't have that kind of deep, focused, rich network that's so often required to help, especially technology businesses, really scale and grow. And I'll do these together. Private equity and I guess raising finance from IPO. I mean, these are clearly valid sources of funding for companies that are later stage. I think from an IPO perspective, clearly the con, if there is one, is that you're then running your business to quarterly numbers, and sometimes that can be a bit restricting. But if your business is later stage and ready to take later stage capital, then there are definitely plenty of sources of finance for that. I'm going to talk mostly about VC, you won't be surprised to hear. From a pros perspective, I mean, there are clearly, dealing with VCs has the advantage in that they typically know the sectors that you're interested in inside out. They've got networks of people that they can bring in. They can access further sources of finance should you require it to grow the business. They've got experience in terms of knowing which business models work and which don't, growing internationally, all of those things that are important when you're trying to grow a business. In terms of a con, it's down to the individual. I mean, the VC business model is such that we need to see businesses scale significantly, and we have multiple failures in our portfolio and modest success and large success. And to make that work overall, then we have to see companies that really do try to, push the boundaries in terms of international growth. And that's not for everyone, because often to really take advantage of a market, it requires you to bring in other resource, other senior hires. It requires further rounds of finance. From a founder's perspective, some folks aren't comfortable with that, with dilution, with having other people in the team. But from a VC perspective, our focus is on building a bigger pie for everyone. And if you're not comfortable with that, then VC finance isn't for you. So how do you raise money from a venture capitalist? Well, that's if you just follow those simple instructions, then then you're fine. Anyone who's tried probably realizes it's not quite as simple as this. And in fact, I would say that the VC process is probably 70%, objective, analytical, and 30% subjective, which makes it difficult. It makes it difficult for entrepreneurs to interact with us when that 30% is there. In terms of the objective piece, it's relatively straightforward to assess that. Do you have a valuable product offering? Clearly, that can be subjective based on where you're at in the development of the business. You know, the earlier you are, the more subjective it is. The more customers you have, then the less subjective it becomes. You know, what are the unit economics? How much does it cost to acquire a customer? How much revenue does that customer deliver over their life? How many customers are there? Do the unit economics change with internationalization? You know, how do you grow a team? Are you willing to bring on hires? All of that is relatively straightforward. In terms of the subjective piece, I like to think about it as kind of pattern matching and prejudice. You know, so that 30% of subjectivity is based on experience. And if this is obviously when I used to go to the gym more often than I do right now. But if you look really closely at that back, you'll see scars. And those scars are the things that typically are part of that subjective profiling that a VC does when they talk to a portfolio company. You know, and we all, I'm sure Anne has and Heidi has as well, scars on our back in terms of past portfolio companies. You know, too early to market is, I've definitely done that. Of course, too late to market, that's the flip side of it. Team issues, you know, I think never underestimate how important the team is and whether they are willing to accept others to join to help on that journey. Clearly, you know, scaling a business too soon. I mean, I think it's definitely the case that trying to prove the business with minimal amount of capital is the best thing to do. And once you've proven it, then it's the time to really raise capital to scale fast. But then, of course, you get into the situation where you don't scale the business fast enough and you lose the market opportunity. And VCs have prejudices in terms of the sectors they like and the sectors they don't, usually informed by the bad decisions that have been made previously. You know, if I see another collaboration business, then, you know, and those bad and good experiences are all part of that subjective process. So how do you navigate? Well, addressing the objectives, again, as I said, reasonably straightforward. Key thing is, you know, you need to be passionate and know your business inside and out and demonstrate determination to succeed. But the rest is, you know, everything that I talked about earlier, you know, the unit economics, scalability, knowing the next 12 months of your journey in detail, making sure the VC doesn't know more about your market than you do, which is generally a bad sign in a meeting. Addressing the subjective is it's harder, but still doable. You know, I think it always helps to get a warm introduction. You know, I don't think we've ever made an investment where a business plan has just landed cold on our desk. It always comes through our network, our CEO network, or other VCs. I think it's always good to bring a VC along in the journey. So socialize the business to start. You know, let them lift the kimono a little bit and let them understand what it is you're trying to do and when you're likely to come out for funding. I think if it's, you know, if you think that the VC is likely to be concerned because you've never done it before, then it's always good to bring on advisors or other non-execs who do have the experience, who can address that potential weakness. And then the VC process is two-way. You know, you're getting into a partnership that lasts for a long time, and you need to get on with people. You know, you work closely, especially in the early years, and there really needs to be a good chemistry. Last couple of slides. You know, so now you know how to raise cash. I genuinely believe the opportunity is huge. I mean, this is, so Instagram, you know, 2 years, they got to 100 million users, 100 million monthly users. 3 years after foundation, they sold for $1 billion. Number of employees at exit, 18. And, do you know, there is absolutely no reason why Instagram couldn't have been based here. You know, the cost of developing product and bringing product to market is, you know, minimal. Server infrastructure costs, you can rent it from anybody. Reaching customers is relatively inexpensive as well. You know, so in terms of actually getting a product off the ground, improving it, and actually demonstrating that initial market adoption, there are no barriers. When I think Tom Hunter was talking at a conference earlier this year, and he talked about this kind of enlightenment. You know, we're going through this other enlightenment period, and I think we are. Enlightenment 2.0, I think, is definitely here. I think the fact that we're seeing lots more startups, I think just says that the creative, innovative juices are definitely flowing again. And I think if you just referring to the minister's presentation, we have fantastic universities. You know, amazing students being turned out. Scotland, I think, is a great place to live. Quality of life is high. We've got good infrastructure. You know, there's no reason to head off elsewhere to start those businesses. And if you, and if you look at, we have got companies that are doing amazingly well. Skyscanner, FanDuel, I'm sure there are more. And the best thing that could happen in Scotland in the next 2 years is for one of these businesses to have a massive exit, either through a public listing or through a trade sale, because actually it will create dozens of entrepreneurs with cash who really understand how to build product and take it to market. And I think we have that opportunity. So that was my intro.
Thanks, Eddie. So maybe I can address this to you ladies. I dare say for every 100 deals you see, you book back one of them. Or be that kind of proportion? Or was it higher than that? Less than that? Okay, so it's 1 in 1,000 or 1 in 500, something like that. Okay. So what is it that you see that actually makes you want to follow up? Because, you know, if these guys want to go and see you guys, they've got to have an idea that they've got to have a better chance than 1 in 500.
Well, I think that, first of all, I'm a recovering entrepreneur, right? I was on your side of the fence and I raised 2 rounds of venture back in the past, and it used to just, it was so difficult because I would think, I know my business, I've got a great business, say yes. Yeah. Meet with me and write me the check. And it didn't happen that way and took a long time. In fact, probably took me 6 months to raise my first round, maybe 9 months. And I was funded by this lady, actually. So, and that was her very first investment as a venture capitalist a while back. We won't say what year it was.
And Winblad was my second investment.
Yeah, so really funny, some ancient history here. But I think the thing I've now learned being on the other side of the fence and being a venture capitalist is, first of all, most deals do not get done that quickly. And yes, you hear the stories about the napkin and the funding, and I think it's funny when you put up a slide about Instagram, because I think, yes, and every week someone wins the lottery, but probably not going to be any of us, and it's not that good of an investment strategy either. So I think that what you have to realize from our perspective is part of the reason it takes time to raise venture is because we're getting to know you. We're getting to know whether you do what you say you're going to do. If you walk in and you say something about a customer you're going to land in the next 6 weeks, we want to see you land that customer. If you tell us what your revenues are going to be or when you're going to ship your beta product, we want to see that, because that's part of how we get to know whether we can count on you and whether you're going to stand up for what you do. So that's point one. And then the second point is you have to get, I use a lot of dating analogies, which I probably shouldn't do, but you know, you're not going to ask somebody if they want to have children on the first day. Well, maybe some of you do, but I don't think it's a good strategy. So I think that, like that with venture, the goal with every encounter with a venture capitalist is to get to the next meeting. It's not to carpet bomb with every piece of information you have. It's to build a story, and it's to build excitement. And I think that the point you made about passion and enthusiasm, you have to show that. I find one of the mistakes people make is as soon as they have our attention, they say, here's 100 pages worth of material that you should read, and here's my, here's everything. I mean, we get pitched all the time, and so I think getting it down to the essence and getting it down to something that gets us intrigued enough to want to come and learn more is what's important. And to me, the most intriguing thing is a person who's passionate, who knows their space, and who is determined that there's a huge problem that no one else is solving. And if you can hit those 3 points, I'm going to come and take another meeting with you.
Yeah, I would add a couple things. I do want to comment on one thing that Eddie said earlier that's really changed in the U.S. We now have a very vibrant and formalized angel funding sector. And we have new VCs called micro VCs, which are sets of entrepreneurs, very skilled, who form their own small venture firms. Some of them will stay small forever. Some of them will become Series A investors like we are. but it does change what we look at now when we invest. Well, it's very inexpensive to start a software company now. The bar has risen as to what you have to have accomplished to get a true Series A investment, because you can do more with less. It's fairly easy based on a product story to go out and get angel funding in the US. And there's a lot of angel money with the Jobs Act that's even becoming more formalized. We have angel lists on the West Coast and GUST on the East Coast, so they're very good portals for angel funding. So very institutionalized as part of the investing stack. So it has a lot more pluses now than it used to have before. It's also one of the benefits, as Eddie mentions, if there's very large successes here and angels form their own, or entrepreneurs that acquire wealth, form their own investing groups, it's a virtuous circle. From the standpoint of investing, there really is one thing. And I use an example of a company that came to us from Imperial College, a little company that was acquired years later for $3.3 billion by Oracle called Hyperion Software. A professor and a sales guy and a guy who worked for NASA Ames, a true rocket scientist, never was a commercial software developer, started a company called Arbor. They came and pitched to us, and even though none of the three people had ever built anything for anybody else, we knew within 10 minutes we were going to fund that company. We funded it with Sequoia. And we knew when, after the entrepreneurs spent about 5 seconds describing the essence of the technical invention, which was multidimensional cubes. Sounds really sexy. In fact, they originally called the company Multidimensional Systems, and we suggested they might change the name. Jim, who is this Jim Dorian, the founder and CEO, had this big scroll of paper, and he unfurled it and said, "Here are the names of 300 customers. I have spoken to all of them. Pick any name. Call them up." And we put them in a car the next day and drove them down to Bill Reducial's office, who was the CFO of Sun Microsystems at the time, and said, "Hey, give Bill the pitch. If these guys built it, would you buy it?" Kicked him out of the room, and Bill said, "Yep, add me to that list of 300 names." One point that's important to get A-round investing. We see lots of great products described. We cannot fund great products. We have to fund great companies. And how do we know they're going to be great companies? That there is really an unmet market opportunity there. And you've actually talked to the marketplace, whether you've used hand puppets, scrolls, or prototypes or real software, that you have a belief, not based on wishful thinking, but based on market interaction, that you can build a real company.
Thanks. One issue that many people here will be aware of is the angel scene here in the UK. It's a very, very strong scene. I mean, there are about 28 angel syndicates in Scotland, and they largely invest on, well, the taxation issues are very important to them, and that creates huge opportunities because they're there willing to invest, and you can get your startup money and so forth. But it does also create other problems because angels with tax breaks don't mix very well with venture capitalists, and it tends to lock people into an angel situation. And when they're ready for their proper B round or whatever, the angels maybe don't want to play that game. It's a bit of a problem.
That's the difference.
Yeah.
These are successful entrepreneurs who really, they want to help build companies. They are company builders still on their own. And it's almost philanthropic when you think about it. It really is. We are part of the ecosystem. We almost have an obligation, and plus every other entrepreneur does it too.
But I would say, I mean, philanthropic is a I would not say most of the angels I know are doing it for philanthropic reasons. They do expect to make money.
Part of their life
They feel it's
cycle.
part of the ecosystem and part of what they do, and it's a pay it forward, I'm going to be involved. And also it's part of the social scene. I don't know how else to put it. It's part of what people do. But I think that the difference, and I noticed it when I was living here and I went to a conference where entrepreneurs were pitching, and every one of them not only pitched what they needed, but they pitched how they were going to develop an exit in 2 to 3 years and what kind of return they were going to generate. We as venture capitalists, we never hear that because, and I think going back to Eddie's point that he was making is, we have to go for the home runs. When you have a couple $100 million or more under management, you are really going for the home runs. That's how our models work. And if you don't go for the home runs and you try to go for these little 2x, 3x in a couple of years, you just can't manage them well enough, and the economics don't work. And so I think it's a very interesting dynamic you have here. On the one hand, I applaud the fact that because of the way your taxation works and the tremendous benefit for an angel investor, that you can get things off the ground with a smaller amount of money. But what I learned at that conference is that's what everyone was pitching to, and that's what everyone was building to. It's one of the complaints you hear today about a lot of the incubators, Y Combinator, Techstars, which have been very successful. But the flip side is a lot of people will complain and say they are designing companies that solve small problems, because you have to get a problem solved. You have to get a minimally viable product in a few months and a few $1,000s. And so what I would encourage you to think about, and I know this is really difficult because you have really built something here that is very successful, but there's some of those laws. For example, I think it's that you can't have more than one class of stock.
Well, you can only have common stock.
You can only have
as an
common
angel,
stock.
yeah.
Well,
Yeah.
when we're going to put $10 million in a company or $20 million in a company, we want preferred stock.
Yeah.
If we have angel investors who came before us, the kind of sophisticated angels we deal with know that they're going to be lower on the stack, and they're going to have come in at an earlier valuation, and they're going to have saved some money to play pro rata with us. And so there's a whole different game that leads to this sort of ability to get to a longer and bigger liquidity path, right? And I think it's one of the issues here that you need to think about, because that's also where your future of foundational companies who are going to acquire your companies are going to come from.
Yeah.
I mean, that is an advantage that we have in Silicon Valley, of course, as we have Google and Cisco and Apple and a lot of acquisitive companies that are vast, right? And so they can do even multi-billion-dollar acquisitions, which in turn fuels this virtuous cycle. So I think it's one of those, you have a great advantage here that frankly we don't have. And as an angel investor, I would love to have that advantage, but I think it does sort of cap the vision and the outcomes.
And the issue that Anne was talking about, in terms of technology people, I mean, there are different kind of angels in Scotland, but there are several technology investors who are much less concerned about the taxation issues. You know, they want to grow big companies. And there's a good fair number of those. But it has to be said, most of the angels in Scotland are from the financial background, so they are looking for a return. You know, they're looking for the exit, and that's one of the issues.
Yeah, the one other thing to mention, Heidi was talking, is that the typical company acquired, at least in the US, is almost 7 years old. And the typical company doing a public offering is closer to 10. So when we invest in these companies, this is why we make a very selective number, is we know we're going to have, for the most part, well, we might have some companies that are Instagram-like, and we've all had many billion-dollar exits, that we're going to be with these companies for a long time. And we want to invest in entrepreneurs who are willing to make that time commitment as well, that they're really in it for the long haul.
Yeah. And can I ask you a question of, it's kind of unfair competition, because the people who are pitching to you, this is the first time they've done it, or maybe they've done it twice before or something like that, but you do it every day. You know, you do this process every day. So what is it they don't know that they should know to make them, you know, give it a more fair contest?
It's actually, what should I know that I don't know? It's really challenging and exciting being in the business of new, because everything is new. So, you know, I think what Eddie said is really great, that there is that 30% of, you know, is this a day where you really are willing to chomp into something really new? You know, when you start sizing up the starting team that comes in, and the typical company we fund has less than 10 people. Even when we funded Wind River, it was 10 guys. And you know, you have to sort of start looking at the raw material and say, okay, I'm going to give these individuals the money. That's why we're called venture capitalists. We invest at the highest risk point, and we hand the money over to the entrepreneurs. We probably now have known them for 35 minutes when we're trying to decide, are you going to have a return meeting with the rest of my partners. We're thinking about, am I going to champion this and want to work with you? I think from the entrepreneur side, the entrepreneurs don't do as much homework as we think they would. You know, they don't pick up the phone and call one of our other entrepreneurs and say, hey, I'm going to go talk to Hummer Winblad or Draper Fisher or Pentech. You know, is this the right group for me? And who would be the person that I should talk to first? And, you know, so that they sort of have a chance to do the right picks. What was it like when you pitched? What does this team focus on? And, you know, I would say that 1 out of 50 entrepreneurs does homework before they get so excited that they have a meeting with a venture firm, that they go hunker down back at wherever they are, you know, work in a vacuum, and then just show up. And they go online and say, here's what a pitch looks like. I better have these 10 things. I'll fill in the blanks. And, you know, they think of it like a television show. You know, it's like Shark Tank in the US or something. But it's not like that. So the entrepreneurs can know a lot more. And plus, entrepreneurs like to help each other. So if they make that one phone call or email or whatever to someone that's already in our tribe, they will learn a lot.
And I think, though, that you brought up something when you said, hey, we do this all day, but the entrepreneur, they don't. Well, my answer is, well, they should. I think that, you know, I probably gave 50 pitches before I got my first term sheet. And by the time you're on pitch 50, you kind of know. So I think I think that's practice is really important. That's why I think going and pitching at contests and getting in front of some friendly fire. And I think, you know, a lot of entrepreneurs will approach me and say, I don't want your money. I just want to come and talk to you, which is really the best way to raise money is to say, no, I don't want your money, not at all, but you know, if you fall in love, go ahead. But I do think you have to do that, right? I mean, I think you have to practice to the point where you're in it as much as we're in it.
I'm going to take questions from the floor in a minute, so if you want to think about your questions, stick your hands up and so forth.
As one aside, we had the opportunity to, in sets of 2, meet with some young entrepreneurs this morning. We met with 10 different teams amongst the 4 of us. And it was great. They didn't come in with pitches. We didn't actually know what the format was. So we could ask these entrepreneurs, what are you really worried about? What's on your mind? What are you thinking? What are your goal lines? And it actually made for some very good meetings, I think, both ways. That's not how pitching works in front of venture capitalists. You don't in front of your partners say, well, what are you worried about now? You do say that. What do you think is your biggest threat? But it's not a conversation. It really is much more of, you know, show us what you got, you know, then we'll ask some questions. So it's interesting. If we see some of these entrepreneurs, again, when they're ready to come and give their formal pitches, we'll know a lot more about them. When we took the taxi over here, we discussed which ones we thought might be successful and why, which ones we'd want to see again, and none of them pitched to us. They just came in and had conversations. But I can guarantee you that about 4 of them could have return meetings with us as venture capitalists.
Any questions from the audience? Yeah, can we get some mics? Yeah, thanks.
Hi, Michael McTernan from STV, at least for a week or so more, and then looking for my next challenge. So if anybody is looking for talent, I'll be around. I liked what Eddie said about Enlightenment 2.0, and I think we are on the verge of a great opportunity. My question is, what is it we need to do here in Scotland, or in Edinburgh, or Glasgow, to encourage that to be the case, to encourage that to be successful? What kind of ecosystem or vibe do we need to have to attract the right kind of talent and also the right kind of money to come here to Scotland? And is that things that we can do collectively as networks, and is it things we need to encourage the government to be doing here in Scotland? So I suppose partly from Eddie, from a Scottish perspective, but very interested in what's coming from America as well, and what advice you might give us.
Well, you know, I definitely don't think we've got a shortage of talent. You know, I think there's plenty of talent around to build interesting companies. I mean, there are always shortages of certain skills. But it's the same in the Valley. You know, if trying to find really great product marketing or performance marketing people for companies in our portfolio in the UK is always tough. There's just not enough of them. But I would guess trying to find the very best kind of marketing folks in the Valley, even though there are more of them, there are more companies looking for that skill set. I mean, in terms of initiatives, I think there are already really good initiatives. I mean, Jamie's there with TechCube, Edinburgh University have got their incubator stuff going on, same in Glasgow. So I think, from my perspective, what's really kind of stimulated a lot of the, creative juices flowing in the last couple of years is the fact that these, these facilities, these physical facilities are there, and they've acted as a bit of a magnet, keeping the kind of smart graduates in the local geography. I think before, one of the issues that I had is that, we're seeing lots of really great folks coming out of all the universities and then heading off to London and going to the incubators that are down there. So I think the fact that we have facilities here is acting more as a magnet to keep the entrepreneurs in the local geography. I think funding is definitely an issue. There is no doubt that there's a shortage of both seed, and later round capital in the UK. It's not just Scotland; it's throughout the UK. I guess London, I think, is much better served at the seed angel side of things. And again, it's back to that. There are more savvy entrepreneurs who made money in London and who are now, starting to put cash into startups. And they're used to working with VCs. They understand how it all works. And I think that, real abundance, I think, of incubator and angel capital, savvy angel capital in London is making a difference. I was being completely serious when I said the best thing that could happen in Scotland is if Skyscanner and FanDuel and companies like that sold for £1 billion, because it genuinely will create a huge, wealthy, knowledgeable talent pool who will be there to actually seed these earlier stage opportunities and give them more chance of success. Then the next stage is, okay, to be really successful, you still need to raise later round venture. And in the UK, there's still a shortage. And that's why I think the most ambitious companies shouldn't just be looking at UK for finance. US, it's hard to pitch to US VC, US venture. There's such a lot of opportunities on their doorstep. Why bother investing over here? So the bar is much higher. It has to be the perfectly formed opportunity almost to attract US VC to here, but it's definitely possible. It's possible to relocate your company to the US. We've got several in our portfolio that have done that and have raised US venture capital. So I think I think there's a lot happening. I think the physical facilities here have had a lot to do with it. I think it's keeping talent in the local geography. That's great. Actually, the businesses like Skyscanner and FanDuel and all these others keep the talent in the local geography too. Because having companies that are really successful and growing fast means that the best and brightest graduates have a reason to stay in Scotland. And they work there for 2 or 3 years, and then they have an idea and they come out and start something up. And I think that's great as well. But actually raising finance, I think, is still challenging. The best companies will succeed, but there's probably a tier right now that are good but not quite good enough that might struggle to raise capital.
I think one of the things I want to pile onto this is that we don't just do deals in our local geography because we're lazy or because we think all the talent is there. It's not that at all. It's because we feel like we have to work really closely with the entrepreneurs. And most of the companies, more than half of all venture deals don't return capital. So part of the reason that happens is because we are betting on really early things and not everything works. And so for us, geography does play. As much as you'd like to believe it doesn't play, it really does. And so it's very difficult for us to do very early stage deals. So one example, we just funded a company called Drone Deploy, came out of Informatics Ventures. They moved to San Francisco. I'm not telling you that because I'm trying to rally that you should all get up and leave here. I think it's wonderful here. I do know people that have bounced back and forth, have said, we'll have an office in San Francisco, we'll have our development team here, we'll bounce back and forth, we'll put our business development people in San Francisco because that's a better place to be. But to have one foot on each continent and get on a lot of airplanes is unfortunately the way it's going to work for a certain class of venture. We have a sister fund here, DFJ Esprit. They're based in London. They would happily do a deal up here, but even DFJ Esprit, they're later stage. So if you are pre-revenue, it's very unlikely that you're going to get an investor from a great distance away to invest in you simply because of the natural cadence that we apply to doing deals and to participating in those deals.
Yeah, I think there's two things. One is, as Eddie talked about, that we as venture capitalists are pattern matchers. I'd encourage you to be pattern matchers as well. You know, certain patterns are not working here at all. Certain patterns are working extremely well everywhere else. Interestingly enough, last year there was about $29 billion invested in venture capital in the US. 50% of it never left the state of California, and most of it stayed within 100 miles of where I live in San Francisco. I would go where the money is, number one. Number two is you're already part of a global community of developers, and that's a trailer for a movie you're going to hear later today from another speaker, so I won't comment on that. Another source of funding that was not brought up on any of these charts, last year about 17% of all venture deals had a corporate investor in it. And so corporations, we have more innovation labs in the city of San Francisco than we have real estate right now. You know, Anheuser-Busch has a innovation lab, Target, Coca-Cola, Johnson & Johnson, Mercedes, Volkswagen, they all have innovation labs, but they're all investing in companies as well. Half of them are European companies who now have offices in San Francisco to vet the investments there. So that is leaving Europe and moving to where the rest of the money is too, because nobody wants to fund these companies alone. So also think about who your customers might be, because for a short window of time at least, corporations are back in this game, and they're back big time. Yeah. And they're very good partners to have if they're the right corporation. So look at these patterns. One of our fastest growing companies is a company called MuleSoft, and the founder's from Malta. You know, he's got a British accent because he grew up here. He moved to Malta because he married this Maltese woman. And, you know, he came over to San Francisco, found a co-founder there, split the company 50-50 with that other guy, went back to Malta, and spent, you know, 2 months on the ground pitching. Got the money, went back to Malta. He's since moved to the States because we have about 100 employees in South America, about 50 here in Europe, and about 200 in the US. And he wanted to be closer as the chief architect, you know, to the mothership, so he moved there. But even there, you know, what were his chances out of Malta getting funding? Well, they're probably not a lot different than being in Edinburgh, and I don't say that negatively. He found the right pattern to match to get the money, and it is a hugely successful company.
Another question? No? Nobody's got a burning question?
Yeah, there's one back there.
Oh, the one, yes, sorry. Yeah.
Hello. Do any of you consider impact or social return as well as financial return, or are there investors looking at what technology can achieve for society as well as for exits?
So there are some entities that do, and of course, you know, we'd love nothing better than to have a business that does good and does well at the same time. But you know, our investors, our limited partners who give us money, they don't give us money and say, well, you can generate a lower return if you also do something really nice for people. Unfortunately, so that's the asset class we live in, is we are really about cash on cash return, and that's how we get to come back and do things more. There are some movements to have certified corporations that are also committing to sustainability and other things like that. We think in a lot of cases it's good business when you have a company that has a philanthropic culture, that has a good work environment, that has diversity as one of their initiatives. A lot of these things they do because ultimately it makes them better businesses as well. So while we like to see that, I think that we have to make our investments based on our prospect of the hard numbers.
One thing I'd say would be crowdfunding. Have a look at crowdfunding, because about $2.7 billion last year invested with crowdfunding, and this year it's likely to be $5 billion. A lot of crowdfunding projects are social projects. They're projects that are geared towards making something happen
Yeah, if you
that the
look at-
crowd wants to have.
Right. I mean, if you look at something like a Kickstarter, some of those things, and in fact, you're not buying equity. That's the other interesting thing here is we've talked a lot about equity and in capital, investing in equity. But a lot of those things, they're just pre-ordering product, which I think is one of the greatest new platforms that exists, is this ability. We just met with a company, they were pitching us for their first professional round. They already have $2.7 million worth of orders for their product. Can you imagine? I mean, I was sitting there listening to them pitch me and I'm thinking, why are you in here talking to me? Because so I think it's a tremendous new platform if you have that kind of productizable, usually consumer-facing product is an amazing thing to do.
Stretch the definition a little bit. Baby Brewdog is a social enterprise, and they've raised they're currently raising $4 million with crowdfunding, so it's quite something.
Yeah, on that note too, I agree with everything Heidi said. We've also had some challenges, in the loan area where small businesses in the U.S. are just not able to get loans. I mean, that's, almost shut down as a result of our last recessionary stuff. But there is a company called Kiva in San Francisco, and they've set up a new loan program that's quite innovative, where instead of having a credit rating or a good credit score or the normal banking requirements, if someone certifies that you're trustworthy, they will then crowdfund your loan. And they recently funded a cleaning service in the city of San Francisco where this industrious young woman was hauling her vacuum cleaners off and on the buses. And one of her employers knew about this loan and promoted her as being trustworthy. And so she was given a loan so she could buy a car, so she could open a little office. And their biggest challenge is word of mouth on this and their own marketing strategy, but it's super successful how they're able to raise the money for loans and how these loans are being repaid very quickly. So that's a structure of business, very small businesses, that is benefiting from a more formalized fundraising strategy as well, sort of a Kickstarter for the masses, so to speak, not just for the typical social good companies.
Any more questions? Yes.
My name is Stuart Rothman. I've just founded a company recently in a fairly large area. I've pitched to you, Eddie, in the past as well. I've just been awarded some money. It's a grant stroke loan from the university, part of an accelerator. I'm seeing my job shift from being a product manager to being a source of finance or finding finance. I was just wondering, we were talking about building relationships with the VCs. How long does that usually last? How long does it take from initial sort of pipping up in the radar, having the initial meetings until you actually sign the check if you're interested? Just wondering if you can speak a bit about that process and how long that usually takes, either for pre-revenue or once you're up and running.
I tell my students at Stanford that if they're going to go raise money when they get out, I expect them to take 50 to 100 meetings and spend 6 to 9 months before they ever get a term sheet. You will always hear about the ones that were competitive and they got a term sheet in 3 weeks, and we see those every once in a while, but that is not the usual thing. You'll usually meet with a VC. I think the honest truth is if they're interested, if they're not interested, they should tell you right away. Remember, it's not in the VC's best interest to give you any form of feedback unless they care about their reputation, which we do and which Ann does. But generally speaking, it's in their best interest to meet with you, learn things from you, and then sort of keep track of you and see what happens to you over time. Because if they turn you down and then you go off and you're successful, they'll feel bad about that. So why not just do nothing? But I think, we usually try to let an entrepreneur know whether we're interested or not within a week of the first initial meeting, or we'll tell them, you're too early, come back in 3 months, or you're too early, these are the things we'd want to see to be able to fund you. So we really do try to keep in touch. But I think 6 to 9 months, and I know with even our funded companies, we tell them that they better start fundraising 9 months before they're going to run out of money.
2 things. When you start doing this, I'm amazed at how many entrepreneurs do not ask us, what is your funding process? And how long does it take to get a no or a yes? Second, there have been recent studies indicating that there is not any seasonality in fundraising. I do not believe that's true. there's 2 hunting seasons, so to speak, meaning hunting for money. One starts like right now as summer vacations are ending and children go back to school. It ends right before what I'd call American Thanksgiving, which is like the 3rd week in November. It does not reopen again until the 2nd or 3rd week in January and shuts again in May 15th. So, you know, start hunting now. And because people take holidays during the summer, during the regular Christmas and other holidays. So there is density where deal making really, really happens the most.
I mean, I think you really need to be clear on the expectations of the VC as well. You know, I think you need to ask yourself the question: is this business really an internationally scalable company? You know, can I get, you know, VCs, because, as we said before, because of the nature of the model, I mean, the business has to scale. It has to get to tens, hundreds of millions in revenue, and really exit for, you know, for a lot of money. And I think we see lots of entrepreneurs who pitch to us who don't really quite understand exactly what a VC needs to see in terms of shape of a company. And you know, from any entrepreneur's perspective, you know, you need to make sure that your time is used as efficiently as possible. You know, because you know, the best thing you can do is make progress in your company, whether it's signing new customers, getting product out, you know, getting letters of intent, whatever it is. And so I mean, we don't have that much time to spend, and you don't have that much time to spend either. So actually, you know, trying to figure out right from the start what the best source of capital is for your company, I think, is probably the most important thing too.
One more thing I would add is have plan B.
Yeah.
Yes.
Because you may not get funding. So, you know, don't do that linearly, like go right to the bleeding edge of the cash you have, not get a venture commitment, and then think, now what's my strategy?
But Ann said something earlier about hunting season, and it's very true that tends to be when deals get done. But I think the best thing to do is bring your company up to someone, you know, you come to me and you say, I'm not fundraising right now, but I think you invest in my sector. I'd like to come and tell you where I'm at and understand what you'd have to see from me 6 months from now for me to get funded. Because first of all, you're not asking me for a decision, because if you ask me for a decision, it's almost always going to be no, right? That's just the law of our averages. But if you come in and you say, I would like your advice, can you give me a half an hour? If you're an interesting company, we'll almost always do that. Yeah. And then the answer is, then you've built that initial thing, then we know you, then you're warm, right? And then you're credible, and when you come back 6 months from now, you'll know what I was looking for, and if you can come and tell me that you actually did what you said you were going to do, that just puts you way far ahead. Yeah. It's amazing to me how many people will only come pitch us when they're 5 weeks from running out of money, which is not the time to do it, right? So build that relationship.
The other thing I will say is that when you get that meeting, just, you know, kind of, I just want to, the socialization meeting, let's call it that. Don't whip out your pitch at that time, but have it in your back pocket. Because in the event that someone does say, you suddenly see them sitting up straighter in their chair, and you know, they forgot they had, you know, a smartphone, and their assistant comes in to interrupt them, and they stay in the room, you know, all those good signs. That if they say, do you happen to have a pitch? Take that pitch out as fast as you can and show the pitch. So don't say, no, I don't have a pitch, because then we'll think, well, you know, you must be working on something. You must have something. But don't start with the pitch. Start with the, you know, a babe in the woods and lost in the wilderness and all that kind of stuff, and then go right into pro land fast.
Wait, I have to. I'm sorry, but I have to follow in, because we were talking about this morning too. But the thing not to do, and I've literally had people. They'll say, I want to come in. I had this happen to me. Someone came in. He pitched me the company, and at the end he said, well, what do you think? Because I'm not even sure I'm really that excited about this idea. I mean, for God's sakes, don't say that to a person that no, he wasn't. He wasn't, but he wasn't from Silicon Valley either. So, I mean, you know, it is even when you're not pitching, every meeting with a potential funder is a pitch. So if you sound ambivalent, unenthusiastic, you know, any of those things, it's just the kiss of death, right? So do know that you are kind of always on stage when you're doing that sort of thing.
Well, I'm afraid we're clean out of time.
Okay.
But thanks very much. Fantastic contributions. So would like to join me in thanking Eddie, Heidi, and Anne.